Good morning, ladies and gentlemen. We're going to get started. Thank you for attending the first session of our Summit on Options and ETFs presented by the Options Industry Council. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us. In the first of today's 4 sessions, we'll be talking about exchange-traded funds, or ETFs. You'll learn all about ETFs, as well as how to build your own portfolio using them. We'll be covering the material, as well as your questions, in a quick 60-minute session. Our instructor today is Craig Daner, a Vice President at iShares. Craig joined BlackRock in 2007 as part of the iShares institutional sales team before moving to the due diligence team in 2013. He has been active in a number of trading and institutional roles since 1998 and holds an MBA from Santa Clara University. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you're able to submit questions at any point during the presentation. Craig will be responding to those questions toward the end of today's session, so make sure to stick around for the entire webinar. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. For your convenience, you can access a PDF version of today's content via a download link that's just below your slide window. And if you'd like to review the entire webinar, an on-demand version will be available a few hours from now via the same link you used to join us today. Additionally, our previous webinars can be viewed on the OIC YouTube channel. And if you're not yet signed up for the remaining 3 webinars we're holding today, visit optionseducation.org for those registration links. And now, ladies and gentlemen, Craig Daner will bring you our topic today, building portfolios with ETFs. Craig?
Great. Thanks, Nick. Appreciate the introduction, and thank you guys for having me here today. It's really a pleasure to be here today to talk to you about ETFs and how to build portfolios with ETFs. Now, many of you may be using ETFs, but many of you may just be dabbling or thinking about using ETFs. So really through this presentation today, I'm going to walk you through, I want you to walk away with a better understanding of ETFs, how they work, why you should use them, and how to incorporate these into your portfolio. Now, over the past 8.5 years with BlackRock and iShares, I have helped hundreds of clients with seemingly thousands of questions on ETFs, and I'm sure many of you have some of the same questions that these clients have had. So please, don't be shy in entering your questions, and I'll do my best to get to them in the allotted time that we have here near the end. So, there's really 3 key points that I want you to take away from this deck. First, I'll give you an overview of the ETF industry, the recent trends. How has the industry grown and changed over the last 15 years? Who are the new users and what are the new uses of ETFs? And how are investors using them to build portfolios? Where is this growth coming from and where do we see the future growth of the industry? Then we'll kind of take a step back. We'll talk about the basics. What are ETFs? How do they differ from mutual funds? How can you build a portfolio with ETFs? We'll also talk about the tax efficiency of ETFs. And then finally, I'll lay out a due diligence framework for how to think about choosing an ETF. What are the important considerations to think about? Now, not all ETFs are created the same, so we'll discuss what you should think about, like things like the manager, the fund's exposure, their structure, the liquidity, and what does it really cost to actually own an ETF? It goes a little bit beyond just the management fee. So with that, let's jump on in here and let's talk about the growth of the ETF industry. And ETFs are one of the fastest growing segments of the financial services industry. It took 16 years to get to the first $1 trillion. It took 4 years to get to the second $1 trillion and 2 years to hit that third trillion. So we've seen exponential growth in ETF assets. Now, more recently, here's a couple of statistics for you. 2014 was a record year for the ETF industry globally. We saw $330 billion of inflows globally. $85 billion went into fixed income ETFs. In the U.S., we saw $246 billion, which was a record also. $52 billion in fixed income, almost a record, just shy of the $52.6 billion in 2012. Now, right now, the global industry sits at just over $2.9 trillion with over 5,500 products. And in the U.S., we're at just over $2.1 trillion in assets and over 1,600 exchange-traded products. Now, at iShares, we're $1.1 trillion globally. About 80% of those assets are here in the U.S., with over 300 products in the U.S. and over 700 products globally. Now, year to date, we're on pace probably for another record year. We are just shy of $200 billion so far this year in the U.S., and the fourth quarter of the year is typically when most of the ETF assets come in due to tax harvesting, institutions and advisors rebalancing their portfolios. So with just shy of 5 weeks to go, there's potential for another record-breaking year. But really, the point I want to get across is that we've seen amazing growth in the ETF industry. 15 years ago, there were just a handful of ETFs, mostly broad-based exposures, broad U.S., broad developed markets, a few emerging markets ETFs, and very little in the way of option volume as well. In 2002, 2003, the first fixed income ETFs were created by iShares that revolutionized the way investors access fixed income. In 2007, the first high yield and emerging market bonds ETFs, HYG and EMB, were created also by iShares. Now, I want to draw your attention to 2008, and that was an inflection point for ETF growth. Now, assets were down, but it was actually a record year at the time for both iShares as well as the ETF industry. Now, really two main reasons for this: liquidity and transparency. So if you think back to the fall of 2008, what was happening back then? Markets started to lock up and liquidity dried up. You couldn't trade certain asset classes. You couldn't trade many areas of the fixed income market, from high yield to investment grade bonds. Even treasury markets were locked up. So investors had to reach for ETFs for liquidity and to lay off their risk. And then as ETF volume and liquidity began to pick up, so too did options volumes and liquidity on some of those products. And second, transparency. You didn't know what was in certain investment vehicles. Traditional mutual funds, they maybe post their holdings on a quarterly basis. So you didn't know back then if your fund held Lehman Brothers, if it held AIG, some credit default swaps, toxic mortgage-backed securities, etc. Now, ETFs, they post their holdings daily. So you have complete transparency into what's inside your fund. And really from there, it was kind of this hockey stick up and to the right with over $2 trillion in asset growth. I mean, yes, we've had a big market move, but about half of this growth was net new money into the ETF industry. So again, liquidity and transparency, those are the two main drivers of growth coming out of 2008. But as we'll get further along here in this presentation, I'll show you a couple other reasons why investors are using ETFs that have helped fuel this growth. So we've looked at the growth of the assets. Now let's look a little closer at this growth in terms of new users and new uses of ETFs. First off, who's using these products? Well, ETF assets are split roughly 50-50 between institutional investors and retail includes individuals and financial advisors. Now, ETFs were originally rolled out to give individual investors access to hard-to-reach asset classes that typically were available only to institutions. But given the many benefits of ETFs, institutions began to take note and really help fuel a lot of the growth in assets, trading volume, and more importantly, a lot of the innovation in ETFs over the last several years. Now, among both institutional investors and financial advisors, ETFs have found a natural fit in strategic and tactical asset allocation portfolios, as they're using ETFs for very targeted exposure to various asset classes in building their portfolios. Now, as we look at the new uses of ETFs, over the last 10 years, both the number of asset classes and the size of these asset classes has grown significantly, with both the introduction of new ETF providers and new ETFs targeting more specific asset classes, which are now giving investors even more ways to allocate their capital, lay off their risk, and build their portfolios. Now, 10 years ago, again, it was mostly U.S. and developed international equity. Less than 5% was in emerging markets. Less than 5% was in fixed income. But now fixed income ETFs represent about 15% of the total ETF market, but have been taking in an outsized share of the total ETF flows over the past several years. So you now have fixed income ETFs that target very specific asset classes, specific duration, even specific regions. Traditional bond mutual funds of the past are not generally as targeted as ETFs. Now, internationally, you can access all of the developed markets in single country funds, and most of the emerging markets and even frontier markets you now have access to. New access vehicles, they're allowing investors to spread out their risk and their exposure even further. Now, finally, if I can draw your attention to that bar there on the far right, the end of 2014, the breakdown of those asset classes starts to look like a pretty well diversified portfolio. You get about 70% in the purple, or in the blue is your developed equity markets. The purple, your emerging markets, at about 7%. Orange is your fixed income at about 15%, and then the other at about 8%. But really, the point is that you have the ability just with ETFs to build a fully diversified, globally allocated portfolio. Now, ETFs will provide you with precise and targeted exposure to all of these asset classes, and we see both advisors and institutional clients building their asset allocation models just with ETFs. And as you'll see in some of the next sessions coming up, with options listed on many ETFs, you can also incorporate options to help build your portfolio as well. So where's all this growth come from? Well, you may hear in the media that the ETF market is saturated with little room to go, but we see a lot of room for growth here. In the chart there on the right, ETFs represent about 13% of the size of the mutual fund market and less than 2.5% of the total equity and debt markets. So they're just a small fraction of the assets out there and simply just another tool for investors to use with more room to grow. Now, we see this growth coming from four main sources. First off, derivatives. There's a movement to physically backed products traded on an exchange with transparency and reduced counterparty risk. So there's been a movement away from futures as well as swaps. Single securities. ETFs give investors the ability to diversify single stock risk and reduce volatility. Right? One security, one ETF gives you 500 stocks, 1,000 stocks, maybe 2,500 bonds, etc. So movement away there from some single securities. And traditional index funds and separately managed accounts. There are different cost and tax considerations for investors where an ETF may make more sense than an index mutual fund. And finally, we see a movement away from some active funds, specifically those that we call closet indexers, which are those active managers that simply hug the benchmark but charge active management fees. Like, why not simply buy an ETF that tracks that benchmark at a fraction of the cost? Or those serial underperformers who consistently underperform their benchmark, who also charge high management fees, and also have high tax costs in the form of capital gains. Why pay active management fees for this type of performance? But now, I'm not saying all active is bad. You may hear the debate in the media about the choice being between index or active. I mean, there's some very good active managers out there, but when you find those active managers that can consistently deliver alpha, you should use them and use them aggressively. So let's take a step back here for a second and go back to some of the basics. What is an ETF and how does it differ from a mutual fund? And this may be basic for some of you, but I want to highlight this for those who may not know this completely. So an ETF is really two great ideas in one. It's a stock plus a mutual fund in one. So you have the characteristics of a stock. It's traded on an exchange. You buy and you sell when you want, And of importance to this audience, there's options available on many ETFs, just like single stocks. You have the same option strategies available with ETFs as you do with single stocks. And you'll hear more about this in depth as we go on with today's event. And you also get the diversification and professional management of a mutual fund. One ETF, again, gets you 500 stocks, 1,000 stocks, 2,500 bonds, etc. But there's also a team of portfolio managers, each managing the ETF to track the index as closely as possible, as closely and efficiently, I should say, as possible, to give investors the experience they expect when they're owning an ETF. So let's look at how a traditional mutual fund works. With the traditional mutual funds, buyers and sellers interact directly with the mutual fund itself. When an investor buys shares in a mutual fund, the cash is invested directly into the fund itself, where the portfolio manager goes out to the market, buys the securities, and conversely, when an investor sells their shares, the portfolio manager must go out to the market, raise the cash, and deliver that cash back to the investor. Now, this introduces two sources of costs inside the mutual fund. One is transaction costs. The fund manager makes the decision when to invest and how to invest, and all these transaction costs that occur when investing are shared among everybody inside the pool. And the second is gains. Well, when there's a redemption, especially in a fund that has had a lot of embedded capital gains, maybe in an equity fund over the last, call it 6-7 years, those capital gains then are realized and then shared among everybody inside the pool as well in the form of capital gains distributions. And this includes those shareholders that are in it for the long haul. They also get affected by these capital gains distributions. So the bottom line here, investors interact with the fund, who in turn interacts with the exchange. And costs and taxes are shared by everyone holding the fund. And this is a pretty less cost and tax efficient structure, but of course the topic is ETFs, and so there is a more efficient structure, which is an ETF. Now, buyers and sellers of an ETF, they interact with each other on the exchange and away from the fund itself. So this puts the investment timing and decision-making out of the fund manager's hands and into the investor's hands. They decide when to sell, when to buy, and of course, when to realize a gain. Now, when there's inflows and outflows to an ETF, or as we call them, creations and redemptions, this is simply a function of excess demand or supply for a particular ETF and take place away from the fund. When there's excess demand for an ETF, shares of the fund are created by what's called an authorized participant. You can think of the big Wall Street banks, Goldman Sachs, JP Morgan, et cetera, who are contracted by each ETF company to create or redeem the shares. Basically, they get a recipe of what's inside the ETF each day to go out and create or redeem. So the AP will go out to the market, buy all the securities inside the ETF, then deliver them in kind to the ETF provider, to iShares, who in turn delivers back units of the particular iShare to satisfy that demand. And the same happens on a redemption. When there's excess selling pressure in the market for an ETF, the authorized participant will redeem shares of the ETF to meet this need. iShares will deliver the underlying securities back in kind to the authorized participant in exchange for those units that are being sold in the market, and the authorized participant then delivers the cash back to the seller. Now, it sounds like a lot, but the key point here is the in-kind transfer between iShares and the authorized participant who sits in between the exchange and the ETF provider. This is a tax-free event, and this is how iShares portfolio management helps to maintain the tax efficiency and also to reduce costs inside the fund. That allows us to track the portfolio, or to track the index, better. iShares portfolio manager will choose to deliver in kind out the lowest basis securities on a redemption and gradually increasing the basis over time. So the bottom line here is, unlike a traditional mutual fund where inflows and outflows affect all shareholders of the fund, the ETF structure keeps ETF investors insulated from the actions of other shareholders because the buy and sell transactions take place away from the fund. Let's take a quick look at some of the differences between an ETF and a mutual fund. ETFs are index funds, and they seek to track a stated benchmark. Active mutual funds rely on portfolio managers' expertise to select investments. This will introduce higher levels of risk in an active fund because some of those choices may simply underperform, while an ETF will mirror that benchmark much more closely. And as I mentioned, buying and selling in an ETF done all day long on an exchange, just like a stock, while a mutual fund is done once per day at the closing net asset value. Fees are significantly lower on an ETF than in an active mutual fund. Taxes, as we just discussed, the differences in the structure of an ETF and a mutual fund, there can be higher capital gains taxes realized inside an active mutual fund than inside an ETF. And this is something to consider as capital gains distributions. What they'll do is they'll draw sometimes with an ETF, because ETFs are not tax-free, they're just more tax efficient. Some ETFs can pay a capital gain, but it's important to recognize this because the capital gain distribution may drop the net asset value of the fund, which will also affect the market price of the ETF, which if you're using options on that may impact the option pricing as well. We'll let more of the experts go into that in more detail later on. So let's take a little closer at why investors are using ETFs more to build their portfolios. So at BlackRock, we think about total performance in terms of three things: return, risk, and cost. So first, return. It's been a very difficult last couple of years for active managers. Many active managers have underperformed their benchmarks and paid high capital gains distributions. And as I mentioned before, investors really don't want to pay active management fees for this level of performance. So if we look at this a little bit more closely, this slide here shows you how your traditional style box managers have performed over the last 5 years relative to their style benchmarks. Now, iShares style box ETFs, so that's your, say, large cap growth, small cap value, etc., have beat over 80% of their competing active style box mutual funds. For example, when only 12% of large cap blend managers or 6% of small cap managers beat their benchmarks, and even fewer beat it on a post-tax basis, which of course is really the only return that actually matters, investors will want to use something that will more consistently perform in line with their benchmark, and that's what the ETFs do. They track closely to the benchmark at a much lower cost of traditional style box active managers and with much more tax efficiency. So given this record of underperformance, investors are using ETFs to outperform other investment alternatives on a standalone basis, so in the style box space, or you're building portfolios of ETFs to outperform other investment alternatives, so both long-term strategic or short-term tactical allocations. Again, you can get very, very precise in your asset allocation strategy to express a very, very targeted view. Now, the second point is risk. Now, you can very effectively use ETFs to manage the risk in your portfolio. And managing your risk is really knowing what you own and why you own it. And ETFs answer both of these questions. First, you know exactly what's inside your portfolio each day, so you're not surprised by something unexpected that won't fit into what your strategy is. For example, if I bought a mutual fund to deliver alpha, the last thing I want to see is a closet indexer. And if I'm buying, say, a bond manager because I want that ballast to my portfolio, the last thing I want to see is a bond manager holding stocks and exposed to higher levels of equity risk. And ETFs also give you that instant diversification, as I mentioned before. One ticker, 500 stocks, 1,200 bonds, etc. So they're diversified basket of stocks on a standalone basis, or you get added diversification with portfolios of ETFs. Now, again, ETFs trade all day long like a stock. You know the price you get when you buy and when you sell. A lot of people think that ETFs are simply trading vehicles. And yes, you can trade these products short term, but with low cost and better tax efficiency and tight tracking, ETFs are designed for the long-term strategic buy and hold investor as well. And with options listed on many ETFs, you can enhance your returns with covered call strategies or protect on the downside with protected put strategies. And also ETFs are transparent, like I mentioned before. You know exactly what's inside there every single day. And the third point is cost. It is well known that ETFs offer lower management fees than traditional investment vehicles, but what's not as well known is just how cost-effective ETFs can be. Now, because ETFs are a broad basket of securities, ETFs offer what we call price improvement versus the underlying securities. Think about LQD, which is the iShares investment grade bond ETF. you get 1,000 bonds for 15 basis points. It would be very cost prohibitive to try to buy all 1,000 bonds on your own, where the average bond spread could be in the neighborhood of 100 basis points. And taxes. ETFs are much more tax efficient than many other traditional investment vehicles, specifically due to that fund structure that we just discussed. And of course, taxes are a form of cost that have to be considered when you're evaluating the true cost of an ETF. Now, at BlackRock, we believe it's not a question of index versus active. I mean, you may hear this a lot in the media, but it's more about using index and active strategies together, using efficient beta strategies complemented by high conviction, high value active managers that can consistently deliver alpha. This can create a better, more efficient portfolio. And it's evident really in the flows that we've seen. Those traditional underperforming style box active managers that we just talked about, they're being squeezed with funds moving in two directions. They're moving upward towards the outcome-oriented, high conviction, high active share funds, and downwards toward efficient beta strategies and ETFs and index funds. And we've seen these managers squeezed to the tune of about $370 billion over the past 3 years, with $750 billion moving up to the outcome-oriented and about $1.1 trillion moving towards efficient beta. So allocating a base of the portfolio to efficient beta, that frees up both a cost and a risk budget to allocate to those active managers who can deliver alpha, or if you want to choose investments on your own, it's freeing up your risk budget to be able to go for something a little bit more risky if you deem that necessary. So how can you build your portfolio with ETFs? Well, iShares has over 300 products in the U.S. here covering a wide array of exposures. But when you want to build that core of your portfolio, you want to take a look at the iShares Core Suite, which offers 20 low-cost products that encompass the basic building blocks of your portfolio. So before, if you wanted to build a portfolio, you either went out into a very broad active or even an index mutual fund, maybe a handful of stocks and a couple of bonds, but your exposure and your returns could have been all over the place and not truly representative of the full investment landscape. But you bring in ETFs now, and now you have the ability to replicate the full global equity exposure in two ETFs if you wanted. ITOT for the U.S. and IXUS for international. Now you want broad-based fixed income? Add in IUSB. And not pictured here, but one of our more recent funds that we just rolled out, the ticker is IAGG, which is the International Aggregate Bond Index. So now you can get the entire global bond market in two tickers. So you can now have a fully diversified global portfolio in 4 tickers where the average expense ratio is probably about 10 basis points. Now, if you want to get a bit more specialized, get a bit more granular, you can break up the global markets into their component pieces, as shown in the picture here on the pie chart on the right. And that's only a small fraction of the funds that iShares offers, and even smaller fraction of what's in the total ETF universe. When you want to be tactical and expressive views, say you want to buy high-yield bonds, you want to buy long-term treasuries in TLT, or U.S. financials in IYF, or even global energy, small cap Brazil, even if that's where you're thinking you want to allocate some risk, whatever you're looking for, there's probably an ETF that you can incorporate into your portfolio to express that particular view. Now, take a look at iShares.com and download our complete product list to see what ETFs are available to express your current view. All right, there we go. Looks like I had trouble with the slide there. Sorry about that. With over 1,600 products in the U.S., how should you think about choosing the right ETF for inclusion in your portfolio? Now, there's really 5 key questions that every investor should be asking themselves when choosing an ETF. First, the manager. How well do you know the ETF manager, and what's their experience in managing an ETF? Second, exposure. What's inside that fund will determine what your risk and your return profile will be. Third, the structure. How's the ETF structured, and what are the implications of those structures? Next is liquidity. Can you trade these products when you really need to? And finally, costs. as I mentioned before, what does it really cost to own an ETF? Now, many investors, when they are evaluating an ETF, they generally start with the fee and usually end there. They simply take the cheapest fund by expense ratio and use that fund. Now, if they look a little bit further, they will look then at liquidity, then they'll look at the exposure, and then finally the structure. So we think that investors should look at this a little bit differently. The number one consideration should be your exposure. What is inside your fund will dictate your risk and return profile. Not all ETFs are created the same. And, for example, not all emerging market ETFs are the same, not all home builders are the same, not all financials ETFs are the same. So once you figure out what exposure you want and which ETF best fits your investment goal, the next consideration should be the cost, then followed by liquidity and structure. So let's look at these a little bit more in depth. So number one, your manager. So how well do you know the manager and what is their capability in managing an ETF? It's not easy to manage an ETF. We've seen managers come and go before, ETFs providers closing up shop, and a few of them recently. So first, you need size and you need scale to effectively manage an ETF franchise. So BlackRock, we're $4.7 trillion of assets, with about 2/3 of that in index strategies, which includes ETFs. You need skill and you need expertise. Now, BlackRock, we have been managing index strategies since 1971. We pioneered some of the very first index strategies and some of the very first ETF strategies back in the late 1990s. And frankly, a lot of that expertise is still sitting in this building here where I am in San Francisco. And you need a track record of effectively managing ETFs, and to have over 700 products globally and over $1 trillion in assets, there are all the products and exposures you need to construct all your broad-based asset allocation strategy. So number two, let's look at exposure. Now, again, this is the single most important consideration when selecting an ETF. What's inside your ETF defines your risk and your return profile. Not all ETFs are created the same. Again, just because it says emerging markets doesn't mean it's exactly the same as another emerging market ETFs. So you really need to look at look closer at your exposure. Does your ETF cover a broad index, or is it narrow? How deep does that index go? Are there concentrations to certain securities that may create unnecessary risks if you were to use that in your portfolio? What's the recognition of the index? At iShares, we use MSCI for international, and we use Russell and S&P for our U.S. equity, and mostly Barclays for our fixed income. So these are all institutional quality and industry recognized benchmarks and providers. Now, one question I get asked a lot, what are some of the common mistakes that you see investors make when they're building their portfolios? And it's kind of a simple answer. An investor's not understanding what index their ETF is tracking and how those indices fit together when building their portfolios. So it's really important to stay within the same index family, because most indices are modular, meaning that the Russell 3000, for example, is simply a combination of the Russell 1000 plus the Russell 2000. Or the S&P 1500 is the S&P 500 plus the 400 mid-cap plus the 600 small-cap. So some of the pitfalls that I've seen, for example, I may see an investor use the S&P 500 for their large cap and then the Russell 2000 for their small cap. But now you have a whole of about 500 names to mid-cap that really can't be easily implemented without a gap or an overlap. Or I might see someone using the Russell 1000 for their large cap, the 2000 for their small cap, and the Russell mid-cap for their mid-cap. But Russell mid-cap is names 201 to 1000 of the Russell 1000, so now you have an overlap in your mid-cap and a mid-cap bias to your portfolio. So again, really knowing how the indices fit together and using them appropriately is very important in determining the proper allocations to your portfolio. Now, number three is structure, and I'm going to pop these little builds up here. So what are the implications of these structures? Now, first off, most ETFs are structured under the 1940 Act, just like a traditional mutual fund. The assets inside the fund, inside the ETF, they're owned by the holders of the fund, just like a mutual fund. So if a manager goes out of business, for example, the assets still belong to the end fund holder, and they just simply get transferred to a new investment advisor to manage the fund again, with investors still owning the assets. Now, most ETFs are open-ended versus a unit investment trust structure. Now, the open-ended structure allows for two things versus a UIT. Now, one, it allows us to reinvest dividends paid from the underlying securities, which helps us track our funds closer, and allows us to lend the securities inside the fund to help generate incremental return to help offset the management fee and track even tighter. Now, unit investment trusts don't allow this. The biggest UIT is SPY, and over the past 3 to 5 years, SPY has slightly underperformed IVV, which is our S&P 500 iShares ETF, because of this cash drag. It has to hold that cash until it pays it out quarterly. Now, there are also some ETFs that are set up under the 1933 Act, and these are mostly the metals products. So IAU, which is our physical gold product, SLV, which is our physical silver product. You may be familiar with GLD, which is the State Street gold product. They're set up under as grantor trust. There's also a couple of commodity products such as GSG and CMDT. But the important consideration here is taxes. First off, the 40 Act generally does not allow for commodities or metals. So the funds, we have to set them up under the 33 Act. And some 33 Acts will generate K1s versus 1099. So that's an important tax consideration for you. And then lastly, exchange-traded notes are also set up under the 1933 Act. ETNs are used when trying to track very hard-to-access asset classes like futures and commodities. The VIX index, for example, and a product like VXX. These are basically 30-year bonds issued by major investment banks, guaranteeing the performance of their underlying benchmark net of fees. But the key concern for investors, and was so back in 2008, not so much now, is counterparty risk, because these are debt obligations issued by a large bank. But if you want very precise exposure to these futures or commodities index, these will give you that exposure to incorporate into your portfolio. And as we examine the fund structures a little bit more closely, one other fund structure to be aware of is the multi-share class structure, which is employed by Vanguard with their ETFs, versus a standalone structure of iShares. Basically, that means that there's no larger investment pool behind our ETFs, whereas at Vanguard it is. Vanguard's ETFs, they're basically a hybrid of a mutual fund and an ETF. So you have a single investment pool with multiple mutual fund share classes, and ETFs are simply just one more share class off this main pool. Now, as we discussed earlier, when inflows and outflows into a mutual fund occur, all the transaction costs and any realized gains, et cetera, are shared by everybody inside the fund. The same holds true for the mutual funds in this structure. Now, while the ETF shares are created and redeemed in the same manner as a traditional ETF, transaction costs and realized gains that may occur in the mutual fund, they're also going to be shared by all the share classes, including the ETF. And we've seen this happen in the past where a large redemption in one of the mutual fund share classes with large embedded gains created a large tax hit, which not only affected the other mutual fund share classes, but also the ETF shareholders as well. And that hybrid structure, it leads to this slide here. There's a higher rate of capital gains distributions in the multi-share class structure than with iShares and the standalone ETF structure, and with the mutual fund structure being the least tax-efficient structure. Now, last year was a huge year for capital gains distributions for mutual funds, and this year is shaping up to be, if not the same, if not more so. Now, last year, 52% of the top 100 mutual funds paid out capital gains distributions. 38% of those paid over 5% of their net asset value. 17% paid out over 10% of net asset value. And like I said, we're seeing the same type of thing happen again this year. So even if you didn't sell your mutual fund and you just bought and hold, you got hit with a taxable gain, and these tax hits are one of the reasons why we've seen investors moving towards ETFs over the past few years. Investors want to pay less in taxes rather than more. Now, I'm not saying ETFs are tax-free. They're simply a more tax-efficient structure. last year iShares paid out on just about 5% of our ETFs, so about 15 of 300s. So, but like I said before, many of you are looking at options on ETFs. It's important to know if there's a capital gain coming, because this distribution will affect the net asset value and should have an effect on the corresponding market prices. So options prices may be affected as well. And number 4, liquidity. Can you trade these products when you need to? Now, I discussed earlier in the presentation that investors back in 2008 started using ETFs more due to the lack of liquidity in other financial instruments. And this is not limited just to 2008. And as you can see, in many of the major stressful market events, ETF volumes have picked up due to the need for liquidity. And you could also notice probably a corresponding spike in ETF options volumes as well. Now, on a normal day, ETFs trade about 25% of the equity market average daily volume. In periods of stress, this jumps to about 35% in the fall of 2008. There were a couple of days where ETFs traded over 40% of the total exchange volume. Now, we saw the same phenomenon happen back on August 24th. And in the few weeks after, ETF volumes were elevated at 40% of the total exchange volume on August 24th. Now, you may hear the talk in the media that ETFs are driving market volatility, but I'd argue that ETFs are actually a beneficiary of market volatility. Now, volatility picks up in the market due to macroeconomic events. So, Greece, the taper tantrum, issues in China, the Fed sneezing, etc. And when volatility picks up, liquidity in many traditional investment vehicles dries up. And so where can one get added liquidity? They get it with ETFs because they trade on exchange. And so hence the pickup in market volume. And finally, cost. What does it really cost to own an ETF? Now, when we laid out this framework earlier, we said that many investors start and in many cases stop with just the management fee when comparing funds. They'll take the lowest cost product and then just move forward. But this only tells part of the story of the total cost of owning an ETF. So again, there's more to it than just the fees. You have 2 types of costs. The first is your explicit costs. These are going to be your brokerage commissions that you know up front, your expense ratio that you also know up front. These are the costs that you can see. Then you have the implicit costs, the costs that you don't see. So what does it cost in terms of the bid-offer spread? If you have a wide bid-offer spread, your cost to get into and out of that fund will be a little bit higher. Tracking error, or how far the fund deviates from its benchmark, is also a form of cost. If you're expecting to get that benchmark return, but you get something different because the fund doesn't track closely, the performance difference should also be considered a cost in your analysis. And then I've harped a lot on capital gains distributions. That's a form of cost too. If the fund is paying out gains, that's going to drag on performance and cause you, the end investor, to have to pay taxes, which adds to the cost. So these factors, your explicit costs plus your implicit costs, combine to give you your total cost of ownership. Now, the 2 charts here on the bottom here, this is HYG, our high-yield bond ETF, compared to JNK, which is the State Street high-yield bond ETF. Both sound about the same. We talked about exposure before. Fees are different. HYG is 50 basis points. JNK is 40 basis points. But if you go back to 2007 and you look at the performance and how closely they've tracked their benchmark, HYG has mistracked its benchmark by a total of 5.7%. JNK has mistracked its benchmark by 25.7%. So if you said, well, JNK is 40 basis points versus 50, I'm going to go with that 10 basis points of savings. Well, that 10 basis points turned into about 20% of underperformance. So this all goes into understanding those implicit costs that you may not see up front. So now there's also an analogy that I like to use. That buying an ETF is a lot like buying a car. And, out here in San Francisco, we see Teslas just about everywhere. And, yes, a Tesla will cost you a bit more money up front as compared to other luxury cars. But think about all the benefits that you get with a Tesla. And I'm not plugging Tesla here. I'm just using it as an example. You're saving on gas. They're pretty well built. So you're saving on maintenance, and they're pretty safe. So you're probably saving on insurance. So you may not think about all these benefits up front, but but over time, you've reduced your total cost of owning that car. So the sticker price is just the price you pay up front, but think about all the benefits that kind of come when buying a car like that. So that's my little San Francisco analogy. And with that, looks like I have about 10, 15 minutes to take some questions.
Craig, thanks for everything today. We've gone through quite a few concepts, and we do have quite a few questions, but I do want to remind our listeners that if they have further questions about the concepts we discussed today or about anything that's on the OIC website, we can always contact the OIC Investor Services team at options@theocc.com. And if you'd like to get more information on iShares, please visit iShares.com or call 1-800-iShares. As I mentioned, today's session will also be archived and accessible in a few hours using the same link you used to join us today. So don't feel as if you need to take everything in right now off the top. And with that, Craig, let's get to some of these questions. And we got a couple people wanting to know about smart beta ETFs versus traditional market cap weighted ETFs. Can you kind of go into what smart beta ETFs are, and then can you comment on those versus traditional market cap weighted ETFs?
Yeah, great question. And smart beta is basically kind of the next wave of growth in innovation in ETFs. I mean, traditional market cap weighted ETFs, they've kind of all been done. Not many people are going to come out with another S&P 500 ETF. So market cap weighted ETFs are just simply based off of a market cap weighted index. The securities with the highest market cap get the highest weight. The lowest market cap get the lowest weight. It's your traditional index. Think of the S&P 500, Russell 2000, etc. Now, smart beta kind of sits at the intersection of index and active. When you think about traditional active management, you have portfolio managers that are making active investment decisions based on, based on their, 700 best large cap growth ideas, right? But if you think about smart beta, there's a couple versions of smart beta to think about. So first, you could think about what we call enhanced indexing, which is you basically take your traditional market cap weighted index and you can kind of tilt and tweak the exposure based on particular persistent investment factors to enhance the return of the index. And when I say investment factors, I mean things like momentum, company size, company value factors, or quality factors. So those are kind of four really persistent factors that we've seen in the marketplace over time. You also have individual funds that you can allocate to based on those particular factors. So if you want a momentum-driven strategy, there is a momentum ETF based on the momentum factor. Or if you want just quality, there is a quality factor as well. Little different than a market cap value bias fund, but these would be focused on specifically fundamental factors of quality in a particular company. Then you also have volatility smart beta products, and these are your minimum volatility, I should say. And these have taken in quite a lot of assets over the past 2.5, 3 years that they've been out. And what these do is they will give you generally the return of that particular index, but smoothing out a lot of the peaks and valleys that you might see in a traditional market cap weighted product by reallocating the fund towards names that may exhibit less volatility than other products. So this smart beta is providing investors with new and more sophisticated strategies than just your straight market cap to help investors allocate their capital, build more efficient, build better portfolios, enhance your returns. So this is where we're seeing a lot of the growth right now in new products. At iShares, we just rolled out four new factor ETFs here just a couple of weeks ago. So you're kind of seeing that growth lately.
Craig, as I mentioned, we have some very savvy investors on our call today, but we also have some new investors. And a couple of questions. Can you just go into what the terms alpha and beta refer to and their importance in selecting funds?
Absolutely, absolutely. So beta is going to be referred to as the market return. That's beta. So when I say the market return, it's going to basically depend on what your market proxy is. Some people are benchmarked to the S&P 500. Some may be benchmarked to the Russell 3000. They're going to have a slightly different return. But based on what your benchmark is, that is beta. So when you compare, let's just say your benchmark is the S&P 500, that is going, and what that return is, that is the return of the market, or beta. Alpha then is anything above the market return. So if the market returns 20% and your fund returns 25%, that 5% difference is considered alpha, or excess returns. It's important to think about alpha and beta. When you're buying a market cap weighted ETF, you are expecting to get beta, the beta of the market, the beta of that particular fund. When you're selecting an active manager, or even when you're looking at smart beta products, you are expecting to get some level of alpha generated by those managers. So we have seen, when I go back to the slide showing the movement from traditional style box managers, those traditional style box managers are destroying alpha, or they're returning less than beta, so it's negative alpha. And again, investors don't like to pay for underperformance.
Craig, is there a general rule for the time frame that you should use when you're investing with ETFs, i.e. how easy it is to exit a position when you want to cash in on alpha?
It honestly depends on what your view is and what your risk tolerance is. An ETF, you have investor types that are day trading ETFs. You have investor types that are holding these products for 20 years or longer. So it all depends on what your risk tolerance is, and what's your view of the appreciation. Maybe it's, quote, topped out and you want to take money off the table. So there's really no set time horizon. We do see the average holding period for ETFs is about 2 years, whereas as compared to mutual funds within investment advisory practices, which is less than 7 months now, simply because of these performance issues that you've seen with active managers. So if you're, like I said, if you're trying to track a benchmark, or you're trying to allocate your portfolio to a particular benchmark, if you're in managers that are underperforming that benchmark, investors are pretty quick to pull the trigger and switch into something new. Whereas with the ETF, you're getting that benchmark return.
Craig, you talked a bit about developing markets. Can you kind of explain a little bit between the difference between emerging and developed market equity as it pertains to ETFs?
Sure. Yeah. Without getting into any investment views on things, just in terms of like a structure and high level, developed markets are going to be your, the U.S., for example, most of continental Europe, Germany, Switzerland, the United Kingdom, those are considered developed markets. Australia considered developed market. Japan. You think about these countries that have fairly robust securities laws, whereas when you get into the emerging markets, things are just kind of starting to pick up there, whether that's China, which is probably as developed as you can get in emerging, or go all the way down to beyond emerging and get into what we call frontier markets. And frontier markets are going to be some countries in the Middle East, for example. You had Qatar and the UAE actually just graduated at the last rebalance in MSCI from frontier to emerging. whereas a country like Nigeria or Argentina, those are still considered frontier markets. Emerging, your biggest ones are going to still be the BRICS, right? Brazil, Russia, India, China. They're still developing. Their securities markets are developing. Their laws are getting better. Their movement of capital in and out of the countries are improving and getting better. So those are kind of the lines between developed, emerging, and frontier.
Craig, why are the costs of ETFs so low given the number of assets that they encompass versus the cost of a mutual fund, for example?
Yeah, well, a mutual fund, and when you think about it in the active space, a fund manager wants to be compensated for his skill, right? He's out there employing a team of analysts, and they're looking at all these companies and trying to figure out what's going to be the best company to buy and put into their portfolio. So they expect to be compensated for that. But with an ETF is based off of an index. Now, indexes are inherently more cost efficient because there's lower turnover in an index. An index is only going to be rebalanced on at most a quarterly basis, sometimes a semi-annual basis. You do have teams of portfolio managers. I used to be a portfolio manager for iShares. And we're not making any active decisions in terms of what securities to buy and sell and what to hold and what not to hold. But our goal is to replicate the index and to manage the risks and the costs and the taxes in the ETF to replicate the index as tightly as possible. And it's not push a button and run off and play golf. There's a lot that kind of goes into it, but the costs are coming down significantly simply because their index and their beta exposure. You should not have to pay a significant amount of money to get beta, just like with active. You shouldn't have to pay active management fees for underperformance or for beta. So it really comes down to the skill of the skill of the manager, if you will, and what their goals are.
Craig, we're coming up on the end of our session, but we have time for this one last question, and that question is, how does the value of a dividend-bearing ETF compare with the index that it tracks?
Most equity ETFs, we'll start there, will pay a dividend. So if you own all the securities in the S&P 500, they're all going to pay dividends at various times. Let's say you own all individual stocks, if you could. With the ETF, in the fund, the dividends are going to get paid. They're going to accrue inside the fund, and then they're going to be reinvested. And then when it comes time for the quarterly dividend to be paid, then the portfolio managers will sell off the little bit of the fund to raise the cash for the dividends and pay out the dividends. So that's a traditional market cap weighted, traditional dividend that you would get. Now you can also throw these in the smart beta category, which are dividend weighted ETFs. And what they do is they screen for companies that are paying high dividends, that have high dividend yields, or that are growing their dividends. And these will be much smaller subsets of a broader index. So, you take something like HDV, which is our high dividend product, or DGRO, DGRO, which is our dividend growth product. And these screen for companies that are paying high dividends or that are consistently paying a dividend or growing their dividends. And they're going to be much smaller subsets. There are only 50 to 100 securities inside these ETFs. And so those companies will pay a higher level of dividends, and then in the same manner, they'll accrue inside the fund and then get paid out on a quarterly basis. So the indexes then are rebalanced according to the index provider's rules for those index, that maybe a company has been paying a high dividend, but for some reason something happened, the company had to stop paying its dividend or it had to reduce its dividend. Then maybe that company gets kicked out of the index, and then a new company will come in. So those are more, while they're not active mutual funds, they're kind of active indices, where the indices are a little bit more actively turning over based upon the rules around dividends.
Thanks, Craig. Ladies and gentlemen, just to remind you, if you haven't had a chance to fill out your surveys, please do so now. And Craig, did you have any closing remarks for our listeners today? I think you have a few slides left.
Yeah, I mean, the bottom line, why iShares? We're a trusted ETF leader. We've got the largest suite of products, the largest assets. Again, when you go back to the manager, we've been managing ETFs for, since the late 1990s. We've got a sustained record of performance, low taxes, tight tracking, low fees, and of course we're powered by BlackRock. And BlackRock is the world's largest asset manager. And if you even think about it, BlackRock's more of a risk manager. And we're in the business of not just managing money, but also managing risks in client portfolios. So all iShares ETFs are powered by the technology that backs all of our portfolios within BlackRock. So when you're selecting an ETF, most likely you're going to come across an iShare, I appreciate the time being here, and good luck with the rest of the day.
Ladies and gentlemen, thank you for your time today. I understand that we weren't able to get to all of the questions that we had, but the OIC Investor Services Desk is ready to help. If you have any questions regarding ETFs and options, which is actually going to be our next session, you can reach our Investor Services team at options@theocc.com. And of course, for more information direct from iShares, please visit iShares.com or call 1-800-iShares. As I mentioned, today's session will be archived and accessible in a few hours using the same link you used to join us today, and our previous webinars are available on the OIC YouTube channel, so you can review a number of option strategies and concepts at your own pace. Also, if you're not yet signed up for the remaining 3 webinars we're holding today, visit optionseducation.org for those registration links. For any financial advisors on our webinar today, the IMCA program ID for CE credit is 15BOE002. That's 15 Bravo Oscar Echo 002. And the FPA program ID is 221306. That's 221306. Ladies and gentlemen, thank you for attending, and we hope to see you again next time.